Before we start this video, do like and subscribe to our channel and not miss on any updates.
What is fundamental analysis? Fundamental analysis is trying to find out the value of the company, the intrinsic value of the share of a company by discounting all the future streams of dividends which are cash flows to the shareholders. So the fundamental belief in fundamental analysis is that the price of the stock depends on future streams of cash flows. If the price that you arrive at by discounting all the future streams of cash flows, if it is lower than the current price, then you're supposed to sell the stock. If the price that you arrive at by discounting all the future streams of cash flows, it is higher than the existing current market price, then you buy the stock. So it is a very simple logic. You use the Gordon formula to find out the price of shares of a company that is listed on a stock exchange. How is fundamental analysis done? There are three basic techniques that are used in fundamental analysis. One is economic analysis, then is industry analysis, and then the third one is company analysis. Economic analysis is analysis of the entire economy, trying to figure out how macroeconomic factors drive or influence or what is the linkage between the macroeconomic factors and the company whose stock price you're trying to figure out. Industry, or it's an industry that is very, very new. So how does the competition play out? How do other players play out? What are the factors that affect the industry and how they in turn affect the company? All of this is looked at in industry analysis. Then you come to company analysis. Company analysis is all about trying to figure out what are the specific features, aspects of the company. How does the company function? Who's the management? What are the pros? What are the cons? What are its advantages? What are its modes? How is it regulated? All the aspects related to the company. Those are analyzed in order to take a decision or in order to predict or in order to project the future cash flows of the company, based on which again you will project the future dividends and then arrive at the price of the company as per fundamental analysis. How is economic analysis done as part of fundamental analysis? In economic analysis, you analyze the macroeconomic conditions existing in a country. What is the GDP? What is the potential growth rate of GDP? What is the inflation rate? What are the interest rates? How are the monsoons? How is the foreign exchange position? You analyze all the macroeconomic factors. Sometimes you can go into things like, what is pay commission report? How does it have an impact on the overall economy? So you analyze all these aspects and try and figure out what is the direction that they are actually giving, which is again relevant to the company. What is the broad environment in which the existing company is operating? And how do you analyze all these aspects? You do it by three things. First one is anticipatory surveys. Second one is barometers or indicators approach. So you have some lead indicators, some coincidental indicators, and some lag indicators. You figure out all these indicators, what are they saying? And finally, you have an economic model building approach. So these are the three approaches that you use in economic analysis. How is industry analysis done as part of fundamental analysis? In industry analysis, you try and evaluate what is the space that is occupied by the company, the target company which you are trying to value. What is the space occupied by that particular company in a specific industry? What stage is it in? What kind of product life cycle is it in? That is it a mature industry? Is it a new industry? Is it probably somewhere in middle kind of industry? What is it? Then you try and look at what is the number of players in the industry. How is the competition structure? Are there too many players or too few players? Then what is the government intervention in the industry? What is the regulatory environment specifically within the industry? Then you look at profitability and cost structures. How are the profits of the rest of the players in the industry? Then you look at demand supply gap. That is there a position of oversupply or there is consistently shortage of goods, right? And eventually also look at the role that is played by technology and research. What stage is it? A very tech intensive industry, non-tech intensive industry? What is going to happen to it depending on the evolution of technology? Then you do all of this and either you use techniques like input output approach or a regression analysis to figure out the linkage of companies' prospects with the overall industry's prospects. How does one do company analysis as part of fundamental analysis in trying to figure out the price of a share? You try to analyze some of the key metrics with respect to a company, financial metrics as well as non-financial metrics. Financial metrics like what is the book value? How are the ratios looking like? What is the long-term trend? Where does the company position itself relative to its competitors in terms of various metrics? Then you look at aspects like quality of the management, quality of corporate governance. Then you also look at company-specific factors like location, your labor disputes, or infrastructure facility that the company has, its specific raw material sources, or what is the specific USP of the organization. Then you also look at issues like marketability of the shares. What is the management structure? How is the organization structured? And what is their levels of professionalism and the pattern of shareholding? You do all of this and then you use techniques like trend analysis or decision tree analysis or some kind of regression to figure out how is the company's cash flows, how are the cash flows linked to various aspects and then around the operations of the company, and then create a model and then based on the model project the cash flows, and then eventually you value the shares of the company by discounting all the future projected dividends. Do you know what is technical analysis and what are its assumptions? Technical analysis, unlike your fundamental analysis, is not based on future cash flows. It is not based on future dividends. It is not based on this discounting methodology. Technical analysis focus more on trends, charts, patterns, and the fundamental assumptions of technical analysis are that history, whatever has happened in the past will happen again. There could be rational or irrational reasons for the way a stock price moves, and that trends repeat, and you can project a trend and you can look at a trend and forecast which way it is going to go. So these are the key aspects that are considered in technical analysis. As I said, it is all about charts, patterns and trends. What is this Dow Jones theory? What are the trends as per Dow Jones theory? The Dow Jones theory was propounded by Charles Dow, who is also the founder of Wall Street Journal. So what does this theory basically say? There are two indices in the US NYSE. These are Dow Jones Industrial Average and Dow Jones Transportation Average. Charles Dow figured out that when these two move together, it can be upside or it can be on the downside with a good amount of volume, then it basically means that the market is following either an uptrend or downtrend. As per this theory, Charles Dow figured out that every market works in some kind of a trend, and this trend basically is divided into two parts, bull phase and a bear phase. And even in bull phase, you have a primary trend, a secondary trend and daily fluctuations. So if you look at bull phase, as the market keeps moving up, the primary trend is the market totally moving up. Secondary trend is one where the market actually goes against the primary trend. That is, even though the market on overall is going up, the secondary trend basically indicates that there is a small correction. And then you have daily fluctuations in between where the price may go up or go down and so on and so forth. And then you have opposite direction movements which are secondary, and then you have small movements which are daily fluctuations. And this particular trend can either be there in bull phase or in bear phase. Even in the bull phase, you have three subphases. First one is knowledge phase, second is the earnings phase, and third is the excess phase. So in knowledge phase, the smart people take decisions, and in the earnings phase, those decisions turn out to be true or right, and in the excess phase, the market is in some kind of a hype. Then in bear trend, you again have three phases, and the first phase starts at the last phase of the bull trend, which is excess phase. So this starts in a phase where it is about distribution. Then you have public participation phase, and finally you have the panic phase where everybody is selling. So this is what is Dow Jones theory. Very, very simple. What is Elliott wave theory? Just like Dow Jones theory, Elliott wave theory propounds basically there are two phases. One is the impulsive phase, second is the corrective phase. Impulsive phase, there is a general trend which basically there is a wave which is moving upwards, in which you have certain movements that are in opposite directions, but again the general trend is in one direction. Then you have the corrective phase, which is exactly opposite of the general trend, where you have the opposite direction movement. So if the general trend, that is the impulsive phase, is upward movement, the corrective phase is actually the downward movement. Even in downward movement, you have some again counter cyclical movements or counter trend movements which are, if the correction phase is moving downwards, then you have some movements in that which are counter to the downward movements. In between, you'll have small upward movements. So these are primarily the two phases, and the waves have certain qualities. Wave 1 to 5 is basically the impulsive trend. In 1 to 5, it is the upward trend, and A to C is the downward trend. And in 1 to 5, wave 3 is greater than wave 1 and 2. And same way, wave 2 is smaller than wave 1, and wave 4 is smaller than wave 3. Same logic applies even in the corrective phase. What is random walk theory? As per the random walk theory, the stock prices move completely at random. There is no connection between any two successive stock prices. While there may be trends, there may be directions, but both the prices are independent of each other. It is just a statistical expression of the past data. So absolutely random. And because of this, nobody can predict anything. The stock prices move in an absolutely random manner, and hence one cannot predict them. What are various charting techniques when one look at stock prices? Very, very simple technique is line chart. Basically, you draw a single line depicting the price of the particular stocks. You may also add volume to it, but definitely you are not adding any other data other than closing price and the volume of that particular share which is sold on a specific day. Then you have something called as bar charts. Bar charts are slightly different from line charts, and in bar chart you also give 4 more data points: opening price, closing price, high as well as low. So there are two horizontal bars on a bar chart which depict actually the opening price and closing price, whereas entire length of a bar actually depicts the high and low. Same way, you have now a candlestick chart or a Japanese candlestick, which basically the shading or no shading. Shading means the price, the opening price is much higher than the closing price. No shading means actually the opening price is lower than the closing price. So if it is fully shaded, it means the price is falling. So if you see continuous series of fully shaded charts, candlesticks, it basically means that the closing price is consistently lower than the opening price. Whereas if you see a consistently empty candlesticks for continuous days, then it basically means that the closing price is higher than the opening price. Also, you have the point and figure chart. What do you do in this? In a point and figure chart, for specific percentage change in price, you change the way in which you represent it on a chart. So you represent up moves by X and a down move by O. And for every certain percentage change, you do a reversal, right? So this is a point and figure chart. What are various market indicators that are used in technical analysis? First one, you have something called as market breadth, that is number of advances versus number of declines. If there are more advances than declines, it means that the market is on a positive trend. Then you have something called as odd lot theory. So you basically take a contra view. Anything that is going up, you sell, and anything that is coming down, you go and end up buying. Then you have something called as relative strength index. So if the relative strength index has values between 0 and 100. If the value of the strength index is more than 70, then if the market is said to be in overbought condition. If the value of the index is less than 30, the market is said to be in an oversold condition. So based on this, you take decisions. Then of course, you also look at volumes. Along with the price movement, you also look at volumes. If the volumes increasing or the volumes decreasing. Then you have something called as confidence index. Basically, it is the index of yield on a high grade bond versus a low grade bond. Please note, high grade bond versus low grade bond. High grade bond will have lower yields and a low grade bond will have higher yields. As the index starts moving closer towards 1, it indicates there is a rising confidence in the market, and it is a lead indicator of improvement in market conditions. As the index starts moving away from 1, it is an indicator of a decline in the market. So these are broadly the kinds of market indicators that you use to figure out the market direction. What are moving averages and what moving averages are used in the market? You have two types of moving averages. One is arithmetic moving average, other one is an exponential moving average. Arithmetic moving average is a simple moving average of historical data. In market, people track 50-day moving average, 100-day DMA. They call it a DMA, day moving average. So they track 50 DMA, 100 DMA, 200 DMA, so on and so forth. Then you have something called as an exponential moving average, which is based on a certain number of days for which this whole EMA process is done, you compute a value of an exponent. The value of exponent is 2 by n plus 1, where n stands for the number of days. And every day, the exponential moving average is recomputed by multiplying today's price, which actually the exponent value, and the previous day's EMA by 1 minus exponent value. And that is how you actually compute the entire series of exponential moving averages. What is efficient market hypothesis? As per the efficient market hypothesis, the stock prices move at random, and the existing stock price is an unbiased estimate of the intrinsic value. It does not mean that the price is exactly equal to intrinsic value. It means every point, every price is uncorrelated with the previous prices or subsequent prices, and every price point is an unbiased estimate of the intrinsic value of a share. As per this, you cannot predict the prices, and at every point there is a change in price because new information is coming in, or some information which changes the price is available with the market, and hence consistently the price is getting adjusted to the new information that is being revealed or that is released into the market. As per this, because of the nature of the market, where there is a lot of information available and a lot of competing players are available, the prices will continue to reflect the unbiased estimate of the intrinsic value of every share of stock. What are the common misconceptions of the efficient market hypothesis? The first one is that the market has perfect forecasting abilities. One cannot be more wrong than that. The efficient market hypothesis does not talk about forecasting abilities of the market. It only talks about whether the price reflects all the available information as on day. The second myth is that the existing mutual fund investors, FIs, DIs, do not have competence, which is why the price is not perfect. You cannot again be more wrong than that. It is just because there are so many people and each one is analyzing the information in a different way, each one is coming to a different estimate based on that information, the price is continuously changing, and that price change is absolutely random. And then stock market is irrational because stock market prices movements are random. In fact, prices are random because investors are rational, and at every point they take a decision based on the latest information available. And finally, because the prices fluctuate so much, it means that it does not reflect the fair value. Again, the market is constantly adjusting to new information that is being released, and hence every price point is an unbiased estimate of the intrinsic value at that particular point of time. It does not at any point say that this is the fair value of a stock. What are the challenges to efficient market hypothesis? Number one is that information is freely available, instantaneously available. Everybody has access to it. Truth cannot be further away from this. In reality, that does not happen. Secondly, human capabilities to process so much information is also very, very limited. Third, it is generally believed that, because investors are rational, at some point the market price will start reflecting intrinsic value, and that does not happen for a variety of reasons. And finally, there are a lot of powerful players, people with access to insider information, large corporates, brokers, or institutions who actually have information which they use to gain to their advantage and which works against the competitive spirit. So this whole efficient market does not exist in real world. What are the differences between fundamental analysis and technical analysis? Fundamental analysis focuses on cash flows and discounting the cash flows to the present. Technical analysis focuses on trends, charts, patterns, and how these trends have played out in the past and how they are expected to play out in the future. Fundamental analysis talks more about economic analysis, industry analysis, company analysis, whereas technical analysis is purely focused on charts and trends. Fundamental analysis is more long-term, technical analysis is more immediate or short-term. Fundamental analysis believes that the price discounts all future cash flows, whereas technical analysis believes that the price captures all available information till that particular point of time. What are the various forms of market efficiency? There are three forms of market efficiency. There are weak form of market efficiency, the semi-strong form of market efficiency, and the strong market efficiency. So in the weak form, the prices in a market reflect all historical data of volume, stocks, information, everything. They reflect all the past data. That is a weak form of market efficiency. The semi-strong form of market efficiency focuses on not only all these historical aspects, but also all publicly available information as on that date. Right, and the strong form of market efficiency not only includes all the aspects that are there in the semi-strong form of efficiency, but also reflects the privately held information that is available. So even the information that is private is reflected in the price of the stock. So the strong form of efficiency is one where all information, public as well as private, is reflected in the stock. Semi-strong is only public information, and weak form of market efficiency, only the historical past information is reflected in the prices of the stock. What are the tests that are used to determine weak form of market efficiency? The first one is the serial correlation test. You figure out whether there is any correlation between stock prices. In at least weak form, there is no correlation between stock prices. Then you have the run test. In the run test, you look at the runs and whether these runs are correlated or not. You use the T distribution and figure out whether all these runs are independent or not. And then you have the filter rules test. In the filter rules test, you basically predetermine a percentage at which you make a buy decision, and again you use the same percentage to make a sell decision. In at least a weak form of market, this kind of a strategy should not be able to outperform a buy and hold strategy. How does one determine whether the market is at least semi-strong? There are three kinds of studies: event studies, portfolio studies, or time series analysis. In each of them, you try and figure out the returns of a particular stock or a portfolio either before an event or an after event. Or in case of portfolio, you figure out if portfolio with exhibiting A characteristics is performing better than B characteristics. Or in case of time series studies, you evaluate whether any public information will provide different returns over the medium term, long term, or short term. Based on all these three kinds of studies, no clear conclusive evidence has come out whether a market exhibits semi-strong levels of efficiency or not. How can one check for a strong form of market efficiency? Security analysts, corporate insiders, or stock market specialists, these people have access to a lot of information, insider information, or information that can have a very, very strong impact on the market. Based on all these three, however, no evidence could be found that any of the markets were actually very, very efficient or were actually exhibiting strong form of market efficiency, because there were a lot of instances in which these three people could get superior returns compared to the rest of the market.